Welcome to our YouTube live, and we'll have an hour together. And so let's briefly talk about the election. I think what surprised me about this one is how seamless it's been in terms of markets. There hasn't really been a big move in currencies. There hasn't been a big move in the stock market. If anything, it's been positive. So I think what we're clearly seeing is a kind of smooth transition. But of course, this is the way that the Labour Party have been positioning themselves in terms of being a party of stability and also being business friendly. So clearly markets have taken that well initially. We'll have to wait and see what happens, whether that actually holds up later on. But certainly for the time being, it seems like a fairly stable transition. In fact, if you look at the change in terms of fiscal policy, what the government's spending, there's hardly any difference. So very small changes, because essentially what's happened is that Labour is going to be constrained by debt to GDP, because they've said that they don't want to get debt to GDP to increase significantly over a 5-year period. In fact, they want it to fall over a 5-year horizon. So obviously that's going to limit what they can do. And if they're trying to stimulate growth, I think they're going to have a hard time, given the very restricted policy changes which they've got in place in terms of spending. But who knows? Let's be optimistic and hope for the best. And it certainly seems to be the case that markets are giving Labour the benefit of the doubt for now. Now, I've assumed that Labour's going to win. That's not obviously the case. It may be that we have a surprise in the polls, a massive surprise, in which case, maybe the size of the majority won't be as big as expected. But I think at this point, it's looking extremely likely that Labour will win. It's simply a matter of how much they win by. So, an hour together. You can ask me any question you like about investing. Please do super chat, because obviously that helps us. Please do like and subscribe, even if you're watching this in a replay, and share this with other people. And hopefully we'll get more people interested in investing. Now, I should mention also that we have our own community, PensionCraft community, and you get certain benefits with that. You get access to a chat application, so you can chat to other members of the community. We now have 1,000 members, over 1,000 members, so I think it's very lively, that debate. Also, the kind of people who are in that forum are very similar to me in a sense. Obviously there are disagreements about things, but generally they're long-term investors. They're very much focused on DIY investing, doing it yourself, and also keeping fees as low as possible. So if you want to talk to other people, if you want to get tips about how to invest and share perspectives with other people, I think it's a great way to learn. And often the people in the community now answer the questions before I do and better than I would. So, I think that's a real testament to the quality of the people who've joined the community. But everyone from newbies to people who've been worked in the fund management industry themselves or investment banking. So a very broad range of experience. And I think people get a lot out of it. And we've also pitched it quite low in terms of membership fees. So do think about joining us. As an example of what we offer, let me quickly share my screen. So this is your dashboard if you are a member of our community. And this kind of gives you access to all the goodies. Now, the one which we've recently published, you get previews of videos, obviously, but we also do explainers, which are only available to members. The members vote on what I talk about. So, for example, this one was all about what types of trust fund are available. And there's a phrase I'd never heard before, which was kind of interesting, which was sideways inheritance. So, I learned myself from having to do these things. And there's a video and notes that go with it. And anyway, those are some of the membership benefits. Plus, you get access to things like the dashboard and the tools, so you can search for our content. Yeah, lots of goodies. Anyway, let me get started with the questions. That's the closest you'll get to a hard sell from me, I'm afraid. Okay. And we've already got some super chats, so thank you for that. And if you ask a super chat question, obviously you make a small payment to us, which we're thankful for, but we'll push you to the front of the queue. And if you're one of our supporters on YouTube also, we'll push you to the front of the queue. So the first question is from Adam Hopkinson, who says, Ramin, had a look at some manifestos. Notice reform suggests Bank of England should stop paying interest on commercial bank deposits. What impact would this have? Well, the way to think of this is one of the ways in which monetary policy gets transmitted is, let's say that the Bank of England is going to pay more interest on reserves, then what can then happen is, well, certainly it kind of incentivizes banks to hold those reserves with a central bank. Where does that money come from? Well, it comes from the Bank of England, and obviously banks like to be paid for their reserves, which they're holding with the central bank, but the problem is that that money which is held with the central bank isn't productive, or isn't as productive as a loan to people in the real economy. So by incentivizing people to hold larger reserves with the central bank, the bank is kind of disincentivized from lending it out to the real economy and taking a risk. So when you cut that reserve interest on reserves, then there's more of an incentive to lend out the money, I guess. So, that seemed to be a positive. But I think the argument here is that this is some kind of subsidy for banks to hold reserves with the central bank. But really, the way I see it is as a kind of mechanism for monetary policy. So, yeah, I don't really think that, certainly Rachel Reeves doesn't think it's a good idea to get rid of that, because it is an important transmission mechanism for monetary policy. So personally, I don't really think that it's going to be a realistic policy, because certainly what you don't want to do is to break that transmission mechanism. And the Bank of England probably doesn't want it to happen either, although they are subject to whatever the government wants to do, because ultimately they're just the bank which its policy is pretty much governed by the government. So the Bank of England can't turn around to the government and say, we're not going to do this. Also, I think the UK is very special in the sense that there's a really clear demarcation now between monetary policy and government fiscal policy. Of course, that's also true in the US, it's true in Japan, but whenever a government tries to put pressure on the central bank to do certain things, that's usually a bad idea, because political expediency and populism don't usually go hand in hand with good monetary policy. Of course, you want to make low interest rates low and, have cheap funding costs for your population, but that comes with its own problems if you're always keeping rates low. For example, when Trump was president, one of the things he was always insisting on was that rates should be cut by the Fed. And, even at times when inflation was very high, he was talking about cutting rates sooner. So, I think there's a real problem with breaking that demarcation line between central banks and their independence and government policy. But in this case, I think it's purely a matter of transmission mechanism. So, I think it's unlikely that that's going to change anytime soon. I'll see if I can find the FT article about it, because it was quite a good one. Bank of England interest on reserves. Yeah, that was quite a funny one, actually. Let me share this with you. It was about financial repression. This is the idea that central banks have to keep rates low, because if they didn't, then the government would have to pay more interest on its debt. So the government puts pressure on the central bank in order to keep interest rates low, so that the debt servicing costs remain low. I don't really buy that. But it was interesting because Chris Giles actually argued that the Bank of England should keep rates low, which was kind of interesting. And yeah, here's the stuff about Reform's economic plan. And there's a whole kind of article about it. Yeah. So this is the Bank of England's holdings of gilts. At one point, it was holding about half of the gilt market on its balance sheet. It is falling now. It peaked at about, what was it, over 800 billion, almost 900 billion. And now it's fallen to about 700 billion, the holdings on the balance sheet. But yeah, this whole argument about financial repression is one that's been going on for ages. Anyway, yeah. Personally, I don't really think it's a good policy. And I think Rachel Reeves is right. When you've got a transition of power, you want stability. Maybe in the second term of the Parliament, if there is one, you could say we're going to make an adjustment. But at this point, people want continuity and they want safety. And certainly they don't want a huge shift in the way the central bank runs things, I don't think. The next question is from Alberto, who's paid in euros, so I guess he's based in Europe. He says, please comment on this article. Experts forecast stock and bond returns 2024 edition. The expected return is higher for developed and emerging markets than US equities. Should I sell the S&P 500 ETF? So let's have a look for the article. So here's reaction on the fly. So by experts, I assume what we're talking about is investment banking strategists, of which I used to be one. And let's have a look. So these are the long-term asset class returns. Now, when I was a strategist, we actually got asked to do this exercise. And put yourself in your position, right? You're a strategist, you're stressed, you've got 10 things to do at one time. Somebody from a magazine, a journal, newspaper, Wall Street Journal, FT, whatever, asks you to come up with these returns, your forecast. What are you going to do? Well, if we're talking about long-term asset class returns, well, these things are mean reverting. So the first thing you'll do is look at the base rates, look at what the historic returns have been. And you can bet that's what these people have done. And then you just adjust based on valuation, macroeconomic data, and just put your twist on it. So what you can see here is fairly similar return forecasts across these different investment banks and Vanguard and Schwab. So some of these guys are the fund managers. Some of these guys are investment banks like JP Morgan. But notice, for example, in developed market equities, the forecasts are all in the kind of range of between 7 and 9.9%. And of course, that's probably close to the historic average, which is about 9, I believe, for the US. For US equities, a bit lower because valuations are higher. So between 4% and 7%. So you can see what they've done. They've taken those long-term returns. They've looked at whether the valuation's high or low. And if it's high, they've adjusted down the future returns because the equity risk premium is lower. That's just another way of saying things are expensive. And when things are expensive, the long-term return reduces. Emerging market equities are cheap, particularly China, not so much India. And there you're expecting between 8.9 and 9.9. And then for bonds, you're getting a pretty respectable return of between 4.3 and 5.8%. So risk adjusted, if you divide it by the volatility, those bonds are looking really tasty at the moment. The yields are looking pretty good compared to the way they were. And the return you're going to get relative to the volatility is pretty good as well. So, yeah, how seriously should you take this? Well, beyond saying that the US is expensive and it's going to be a bit lower, the return, future return, you can't really say much more than that. But do I buy the forecast over the next decade? Maybe. You know, the trouble is that even if things are expensive, it's a very bad timing signal. Things can stay expensive for years. And that means that valuations are a very poor timing signal. But if you are going to be investing now and holding for 10 years, yeah, maybe you'd want to tilt away from the US slightly. I'm not doing that, I should stress. I just keep it in a developed markets fund, 90% of my money, and just leave it there. Because I don't really think I can predict these things. But yeah, over a 10-year period, if valuations are high, usually the returns are a bit lower. But who knows, there could be surprises. As the Fed cuts rates, that's good for growth stocks. So maybe we'll see another surge in US equity to even higher valuations. Or if growth continues, perhaps, you know, things will get even better. So I don't think you can really forecast these things. But it's interesting, right, to look at these numbers and look at the justification for some of the forecasts. But you can bet that's what they're going to be saying. If you look at the valuations, let's look for the word valuation. Yeah. Foreign stocks valuation, advantage, because they're cheap. Elevated equity valuations in the US is the main constraint on US equity gains relative to the gains over the past 20 years. So I think it's important also to realise that the last decade has been very unusual in the degree of US outperformance. Of course, it often outperforms, but the last decade's just been exceptional for the US, last 2 decades. And I expect that in the future it'll be much lower than we've seen in the past 20 years. Simply because of the long-term averages. You know, I just think that's unlikely to continue. Oh, and here goes one from GMO. So that's it's obviously going to be quite bearish. Yeah. So anyway, yeah, valuation is the tilt, and the base rates are what they're tilting one way or the other. But would I pay a lot of attention, and would I shift my money? No. I'll just keep it simple and keep my allocation as it is. Right. So to answer your question, Alberto, should you sell the S&P 500 ETF? Well, if that's all you've got, I'd say yeah. Because personally, I wouldn't just buy one ETF for one country. That is concentration risk. Not only is it concentration risk, but it's concentration in just a handful of stocks at the moment. So I don't know if you've seen this article, which was just published by Goldman Sachs, about the S&P 500 being too concentrated. And they've got various ways of showing this. The market cap for the US, for the 10 largest companies, that makes up about 33% of the S&P 500 for the top 10 as a proportion of the total, whereas the earnings is only 25%. So in terms of the profits generated, those 10 stocks are really punching above their weight. And in fact, that's because of their high valuation. And of course, that's to do with the AI narrative, which has puffed up those stocks. And those have been driving, you know, the largest companies have been driving the S&P upwards. And the concentration of the largest stock relative to the 75th percentile, also very extreme, much more extreme than it's been since 1932. And unfortunately, that was just before the big sell-off that we got in 1932 and 3. So yeah, the US is expensive relative to the rest of the world, and in the past that's usually been a precursor to a sell-off. So make of that what you will. But would I just if I had 100% invested in the US, I would be nervous. At least with a global index, you've got 30%, 35% invested elsewhere. So, yeah, that's probably going to increase your return, I'd say, long term. But, yeah, global index is probably a better idea anyway, in my opinion. Right. Apparently I'm quiet. So let's see if I can increase my volume. My voice is a bit hoarse today. I don't know. We've just come back from holiday. We've just been to Milan and to Switzerland for a wedding. And I think I might have caught something on the plane, which is off on the way. Let me just pull up my volume settings. And yeah, let me just turn up the volume a little bit. Let's put that up to 85. So hopefully that's a bit better. Hopefully my voice is a little bit louder. But I think it is. I think it is because I caught something on the plane. Sorry about that. Milan, beautiful country, beautiful food. Really enjoyed it. And Switzerland, Lake Lugano, beautiful. Loved it. And Teddy's been with a dog sitter for a week, and he was getting a little bit pissed off by the end of it. I think he was actually missing me. I get separation anxiety, so does he. We kind of miss each other. Anyway, Alberto says, what's the point of being a contrarian investor? There is a reason why something falls or is cheap, unless I think to be smarter than everybody else. Thanks. Yeah, I think always you should be thinking, why is it cheap? Is the reason why it's cheap an overreaction? And if it is an overreaction, then is it going to recover? Because sometimes things don't recover, particularly single stocks. For an index as a whole, or a whole sector, eventually it will recover, because whatever it is that sector does must be useful. For example, energy. So if energy stocks are cheap, the question you've got to ask yourself is this a structural change? Is this a long-term change which is not going to reverse? Is this because fossil fuels are on the way out? Is this because there won't be a transition to cleaner energy? Or is this because that'll be really expensive, the transition, so they won't be profitable for many years? Always think in terms of, will the recovery happen? And for example, I made pretty good money by buying stocks in the finance sector in the US just after Silicon Valley Bank went bankrupt. And my logic was that it had big banks in that index like JP Morgan and Morgan Stanley and Bank of America and Citi. Now those banks were in pretty strong positions. There was this pretty good growth in the United States. People still need banking services. Banking services are still profitable. And so there are many reasons why I thought it would recover, and it did. It took a while. I made about 30%. So if you do see a kind of depressed price, France would be another example recently where political turmoil has pushed down the value of the index and made the UK look like a bastion of stability, which really tells you something. And again, you should be thinking, well, is France never going to recover, or is this just a buying opportunity? So it's all a question of, how depressed is the price? Has that factored in all the bad news? And is it going to recover? And in those two cases, I'd say the argument's pretty strong that it will recover. There's another one, which is China, of course, which is also very cheap. And there's a kind of binary outcome, I'd say, because of geopolitical friction between the West, particularly the US and China. And that could resolve itself in further conflict in terms of the trade war escalating, and perhaps even a shooting war in the South China Sea. It could come to that. So in that case, I'd say there's a higher risk of it not recovering. Certainly the policy mistakes that China's made recently don't bode well. It seems to not care about its position on the international stage, particularly for the West. And it seems keen on allying itself with Russia and North Korea. So if that's the case, then yeah, it's kind of isolating itself, and it could go down the route of Russia. It could decide to invade Taiwan, and that way you could really lose a lot of money if you were heavily tilted to China. So always think about those things. Is this going to be recoverable? Is it cheap for a reason that's not reversible? And how cheap is it? China's very cheap. But those are the ways I'd approach it. So I think contrarian investors, yeah, do it, because don't tilt hugely towards these recovery plays, because they can take a long time to recover. My small cap investment in the US still hasn't gone anywhere, and that's partly because of currency. I bought an S&P 600 tracker because the small caps in the US are so much cheaper than the mid caps and large caps that it's looking like a very good buy, because I would expect those valuations to converge. So yeah. Oh, there's a question. Can I send Teddy up? That's Laura. Obviously, what happens is he starts whining. And then, so Laura's going to send him up. I'll rattle the... I will get back to the questions, I promise. Teddy! Teddy! Ted! Oh, here he comes. It's funny, we get AI to put the chapters in. Oh, here he is. And this section comes up as dog tricks and general chat. Or is it informal chat? Here we go. Ted, look, you've got to stand on your back paws, mate. No, you've got to work for it. There you go. Oh, very good. Clever boy. Very good. Come on, over here. Don't tread on me. There we go. Very good. Oh, I dropped it. He can also shake now, and he can twist. And obviously the stand. What else can you do, mate? Oh yeah, he can roll one way and the other way. It's very good. You can't see it obviously because you can't see the floor. Anyway, that's your lot. It's all gone. All gone. Oh yeah, he's off now. Go on, you go to Laura. He's listening for the biltong. Okay. So fickle. The next question, super chat from ENP, is one of your older videos suggests Vanguard target date funds for relatively short medium-term goals. Do you still like that idea? I think, yeah. Look, the target date funds, if you're not familiar with them, all they do is they de-risk based on how long you've got to retirement. So if it's going to be retirement in 2030, we're not too far from that now. So it's probably already reducing the amount of equity, increasing the amount of bonds, and de-risking as you approach retirement. So will I buy one of these for actual retirement? Probably not, because they reduce the flexibility because it's an all-in-one fund. What do I mean by that? Well, let's say that equities crash 50% tomorrow, but bonds don't. Well, if you had two funds, if you had a bond fund and a global equity fund, the equity fund's halved, the bond fund hasn't. So if you rebalance, what you'll end up doing is buying equity really cheap and then selling the bonds which have held up. So what's going to happen through the rebalance is going to generate return for you because you'll buy cheap and you'll sell high. So that's generally more flexible than a target retirement fund where everything's in one. you can't sell one thing and buy another, and you've got no control over that. So I think I prefer the flexibility of having, the subcomponents. But if you've got a short-term goal, an easy way of finding a diversified fund is just, a target date fund or life strategy 20, 40, 60, 80, 100. If it's a short-term investment, then you go for life strategy 20. As you dial up the amount of time until you need the money, you go up to life strategy 100 or target date retirement fund 20, 30, 40, 50. I think they're spaced 5 years apart. But that's effectively doing the same thing, which is to increase the amount of equity in the fund. So I prefer life strategy as, if I had to choose a single fund investment, life strategy is probably better. There are also some HSBC portfolio funds, as they're called, which are comparably priced to life strategy. They've got slightly different names, from things like dynamic or adventurous or cautious, but effectively it's the same thing. I think there are 5 of them graded by risk, and they come in income and accumulation versions like life strategy, so very similar, depending on which platform you're on. Some may be available, some may not, but that's what I'd probably go for. But do I still like the idea of those funds for short and medium term goals? Only if you're a newbie. I think if you've got a bit of experience under your belt, you're probably better off just mixing your own with a global equity fund. They're all pretty much the same. A global bond fund or a money market fund as the safe investment, or some combo of those two, the global bond fund and the money market fund. And money market funds at the moment are generating a higher return than let me just show this actually. Yeah, they're generating a much higher return at the moment still than the entire yield curve for bonds. Oh, I've chosen the wrong one. One sec. So these are our trackers. If you're a member of our community, just go to pensioncraft.com/membership to join, but you get access to these trackers. And the one which members seem to like a lot at the moment is the yield curve. It's also available in the form of a table, but the yield curve at the moment, so each of these blobs is one UK bond. There are about 64 of them outstanding, with maturities up to 50 years in the future. But notice how all of the high yield ones, the ones which are high up on the y-axis, the y-axis is the yield to maturity, all of those have a maturity of about 1 year or less. So all the juice is at the short end of the curve, up to 5 years. So the highest yielding treasury gilt at the moment is the 5% of 2025, ticker TR25, and the yield there is 4.9% roughly. So if you're going to be buying a money market fund, which is currently giving you over 5.2%, then it's going to be off the scale compared to the rest. So yeah, that's simply going to be more attractive. So I think at the moment, the safe thing would probably be a money market fund, and personally I'd go for a kind of roll your own life strategy, which is just global equity, and a safe thing, which is money market at the moment. And then later on, when rates start to fall at the short end, maybe you'd go for a kind of belly of the curve 7 to 10 year gilt fund, or a global equity fund, or a global bond fund which is currency hedged, for example. Then we got the Teddy comment, and let's see how we're doing. So we're halfway through. My voice is still holding out, which is good, just about. Not a super chat, but a question you can get your teeth into. Okay, that's from Laura. Hi Ramin, I have a £50,000 ISA with St James's Place. Okay. And I'm considering transferring it to Vanguard to buy Life Strategy 80 and VHVG, which is the fund I've got, Developed Market Equity. The fee at St James's Place is currently 1.97%. What are your thoughts? Well, remember that they've got this kind of graded exit fee for pensions. But this is an ISA, so I don't think there's an exit fee for that, but it's probably worth checking. But would I hesitate if there wasn't an exit fee? Personally, no. Unless, and this is a big one actually, unless you're happy with the service. Because some people really like St James's Place. For me, I wouldn't consider it because the fees are just so high. But look, you get people at the end of the phone that you can call anytime you like. They provide other services like inheritance planning and tax optimization. I have to phrase that carefully. But all of that is part of the package, which you wouldn't get with Vanguard. They're not going to tell you about tax optimization. They're not going to tell you about inheritance planning because they don't provide advice, not anymore. They kind of had restricted advice before, but they scrapped it. So, yeah, just think about whether you enjoy St James's Place. Some people love their advisor. You know, I was speaking to someone yesterday and they said, you know, it was this morning actually, and they said, I really like my advisor. So, you know, I'm kind of considering going with this advisor, even though I know they're going to charge me fairly high fees. So really, you know, for me, no, I wouldn't stick with them. And for a fee of 1.97, I'd expect something amazing. But you've got to ask yourself the question, is this service worth giving up 2% of my return forever? And if the answer is no, well, that answers the question for you. But I would never say, you know, everybody should leave St James's Place. That would be crazy. Some people love the service. You just read the testimonials, and assuming they're true, of course, then, you know, some people must be getting a service they really enjoy. But personally, the reason why I think the share price has gone down so much, let's have a quick look at the share price. I wonder if it's recovered at all. I'm guessing not much. But they've had catastrophic share price falls. I think it was something like 80% at one point. That's JP. St James's Place. Here we go. STJ. That's the ticker. And share. Oh, it has recovered a bit. There we go. So if we zoom in, the happy days were at the end of 2021 when it was trading at £17 a share. But then, as the FCA warned about customer duty, care of duty, it got a series of raps on the knuckle, 3 successive raps on the knuckle from the regulator, and overall it's fallen, oh gosh, peak to trough, it fell, how much is that, 74%? But it's come off the bottom now, so maybe there is a bit of a recovery. But as long as they don't get huge outflows, I think they could be okay. It's just that the size of the amount of money they had to put aside for fines and for customer reimbursements was something like 470 million. So £500 million in expected customer redemptions, repayments, for presumably for not offering the service which they were expecting. Now, if a company sets aside that much money to reimburse its clients, you're just thinking, well, that's kind of admitting there's a massive problem. So, you know, markets really didn't like that, understandably. And that's why the share price fell from £17 down to, well, 4. Not good. But yeah, certainly I'd consider moving if it was me. And I suspect many of the PensionCraft community, many of whom are refugees from St James's Place. Happy refugees, it has to be said, because they found a community which touts the idea of low fees and managing it yourself and provides mutual support in order to do that, which I think is really important too. But yeah, I'd say personally I'd move. So let's go back to your questions. And don't forget, if you haven't voted yet, you can until 10 p.m. I believe. I think the polls are open till 10. When can I vote until tonight? I think it's 10 p.m. Yeah, so it's 7 a.m. to 10 p.m. today. So if you haven't voted yet, go and do it. Whoever you want to vote for, doesn't matter. Just do it. Use that right, because a lot of people haven't got that right. So you may as well use it. Okay. Back to your questions. I'll scoot up to the top here. We're doing 20 minutes, so we've got loads of time. Agrippa, you were a great emperor. Good to see you, Ramin. Thank you for doing these live streams. I can't believe you're still around. Is that 2,000 years? Incredible. Yeah, there's the St James's Place question. Having a 50k to move already. Information. Love the channel from over here in Texas. This is Punkus, who's from Texas. Do you see any sign that the US market is broadening out? What sectors spike your curiosity at present? Well, I kind of mentioned that I like small caps in the US. So let's have a look at Yardani's graphs. I now have to find the link because he's moved his graphs around. Here we go. Yeah, this is really interesting. I love Yardani's graphs, but they're just so hard to find now. Make myself a bit smaller. Here we go. So let's go to the forward price to earnings multiple, forward revenue. So the S&P, here we go. So the S&P 600 divided by the S&P 500. So if this is going down, that means the S&P 500 is outperforming the 600. So large caps are outperforming small caps. And you can see that's been happening in spades. So my turnaround play, which is to buy the S&P 600, the small cap index, has been a disaster so far. Actually, not such a disaster. It's just the S&P has been doing so well. In absolute terms, the S&P 600 has just been going nowhere. So this is the forward earnings per share and margins. Yeah. Now, of course, one of the problems with the small caps is the margins are so much smaller. So the margins are around 6, whereas the forward profit margin for 6%, whereas for the S&P 500, the forward profit margin is 13%, so much more profitable. So the S&P 600 is cheap for a reason, of course. But if we look at the forward PE ratio, the thing which really catches my eye, look at the difference between the S&P 500, the large cap index, which is in red, which currently is trading at a multiple of 21 times, 20.9, versus the small cap index, which is at 14.1. Just look at the size of that difference. You know, we're talking about sevenfold difference, a kind of a difference. If you take the difference between the multiples, it's 7 times multiple difference between the two. So that difference between the two is absolutely huge. And I would expect this to be mean reverting. If you go back to 2016, for example, notice that the three were pretty much in line with each other. All of them were trading at a 16, 17 times forward multiple. So when you do get these divergences, one way or the other, you know, the S&P 500 was trading below the S&P 600 in 2014. What usually happens is they mean revert. So that's what I'd expect to happen again, either because of the S&P 500 falling or the S&P 600 rising to meet it, or a combination of both. So, yeah, it just seems like a huge disconnect at the moment between the two. But in terms of other things which look cheap, the other thing which I find useful is FinViz's sector forward PE. So just Google FinViz sector forward PE, and hopefully you'll get this. This is too granular. So hopefully there's a industry. Let's do it by sector. Yeah. So we'll sort by forward price to earnings multiple, and we'll sort from cheap to expensive. So what's cheap at the moment? Energy. So that's still an interesting one. Financials, still relatively cheap. So the price to earnings multiple there is 13. So 10 and 13. 14 for basic materials, not a sexy sector. Do we still need basic materials? Yes. So, maybe that would be a more attractive group of sectors. And of course, utilities, which are quite boring again. The defensives. Who wants defensives when the economy's strong? Payrolls are strong. The Federal Reserve's cutting interest rates. Those are not the kind of environments where you'd think about buying defensives. But of course, that's why they're cheap. So all I'd say is, look at these valuation measures by country, by sector, by size of company, small cap, mid cap, large cap, and just think, is this going to turn around, and is it justified? And if it is going to turn around, in your opinion, then it's certainly worth considering switching and putting some money in there. Now, whenever I do this tactical stuff, I should mention this. I always do it in the fund portfolio. This is the 10% of my overall wealth, simply because I don't think I can call it correctly much of the time. Maybe if I was more confident, it would be 20% of my portfolio or 30%. But, just gauge based on your own track record how much you should put in the fund portfolio. If you've got a really good hit rate, then, make it bigger. But personally, I just know I'm not very good at it. But it is fun. And it stops me from fiddling with the core portfolio, so that's why I do it. So back to your questions. How are we doing? 13 minutes. My voice is picking up, I think. And there's another super chat, thank you, from L. Cohen, who says, looking to buy S&P 500 or QQQ. So that's the NASDAQ tracker. So it's either US large caps or US large caps with a tech tilt, which are even more concentrated than the S&P 500. I'm concerned about Mag 7 in the index. I'm currently in money markets. I assume that's what you mean by MM. I would need money in 18 months. Oh, okay. Well, if you're going to need the money in 1.5 years, you can pretty much toss a coin to see which way markets are going to go. Maybe the upward drift starts to kick in after a 18-month period. But, even over a 1-year period, markets have a volatility of 16% for an index. For the NASDAQ, probably a bit higher, 18% maybe for growth stocks. So I think there's no way I would put money into equity if I need it in 18 months, because there's a fairly good chance that it'll go down instead of up. The place where equity really works is over long periods of time, 5 years, 10 years, even better, because there the compounding and the upward drift of profit really dominates volatility. So short term, if you look at stocks over a 1-day period, 1 month period, you're kind of tossing a coin, 50-50, up or down. If you're looking over 5 years, 10 years, what you're observing then is the drift, not the volatility. So those are the two components, the very large volatility with an overlaid upward drift. And then over long periods of time, the drift dominates and the volatility shrinks relatively. So that's the way to think of it. And that's why when people ask you, how long are you going to be investing for? When will you need the money? It's because of that very fact. For short periods of time, you don't want to put your money into something which is volatile if you want a known payoff. But look, if you're going to be investing for 18 months, you can put it into treasuries, US treasuries. The yield isn't great, but it's not too bad. Let's have a quick look at the US yield curve just to have a check. So this is available in the FT. Oh, interesting. India's passion for gold fades. Okay. That's not what we're looking at though. We're looking at markets data and bonds. Bonds. Here we go. And the yield curve. So this is the UK yield curve, inverted as we said. US also inverted. So up to the 2-year point, look, you're getting reasonable yields. They're not amazing, 4.7%. That's not too bad, is it? So, if you wanted the money in 1.5 years or 2 years, you can put, 5% less than you'll need in 1.5 years in today. And then the return over that period of time will be 1.5 times, 4.7. 1.5 times, a bit higher than that, 4.8, something like that. So, you get a known payoff, to the penny what you're going to get, the yield you're going to get, hold it to maturity, don't care about the yield curve, it can fluctuate all at once, you get a known payoff, and then whatever it is you want that money to be spent on is going to be in your hand at the right time. So I think for these kind of things where you're planning a known expense over a fairly short period of time, single government bonds make a lot of sense in your domestic currency, of course, because then you're not taking a currency risk. Or at least, that's the way I see it. How are we doing? So we've got 8 minutes. We're getting closer. And we'll look at your questions again. Where is Bubby? No Bubby. Okay, well, Bubby made it, right? He did his tricks and everything. Teddy. Oh, interesting. Tommy Tinkler says, anyone buy the dip in India? Did India have a dip? I didn't realise that. Oh, actually, I did see comments about it on Twitter. Yeah, now you mention it. More questions. Snooze place. Okay, good one actually from Mark T. Just wanted your opinion on holding Vanguard VHVG or VEVE. So that's the accumulation and income version of that developed market fund as your main 90% of portfolio global tracker. Or would you recommend another Vanguard index fund? If you want to see a video about that, I made one called One Fund to Rule Them All, which was a kind of Lord of the Rings reference. And I'd also did a more recent one about the best global equity fund. So the gist is there's not a lot to tell between them. If you plot the returns of any of them, they'll be very similar because there's only one world. And if you buy all the stocks in the world, well, most of them, 80% of the global market cap, you're going to end up with similar returns. So you have a lot of Nvidia, Apple, Microsoft, Alphabet, the usual stocks will dominate and the returns will be very similar. So really, it's only fees which discriminate between them. So personally, I would just go for a low fee global tracker as my core. And if you're not comfortable with 100% equity, which many people aren't, and I think they shouldn't be, then include some safe stuff. And the safe stuff would be money market funds, global bond funds. And then optionally, you can put other things in like a gilt ladder or a treasury ladder if you're in the United States. If you're in the US also, you could consider municipal bonds because they generate a pretty good return and you get tax breaks. But the core is going to be stocks and bonds. And then the kind of driving force, the long-term driver of return will be the stocks, and then the bonds will act as a kind of ballast. And then if something bad happens in the equity market, you can rebalance and buy stocks cheap and generate a bit of return that way. But really, don't sweat it when it comes to global trackers, because there's so much competition now and the fees are so low. This is a market that's been vanguarded to death. It's got really low fees. There's huge competition. And these companies which can massively scale their funds can just, you can buy it for a handful of basis points in most countries. So that's probably what's best. And there are loads to choose from, Right, are we doing for 5 minutes? And Tom Whitehead, 23. I'm guessing that's his comment about St James's Place. And, oh yes, podcast. I've got to mention this. Many Happy Returns is our podcast. Returns podcast. Here we go. So Michael Pugh and I, we do this podcast together. And this week was about home country buyers. Should you overweight domestic stocks? Because for a long time I've been saying that I don't like life strategy. You can see Michael now. That's better. He's young and beautiful, not like me. So I think, I complained that life strategy had a 25% UK weight, which was 6 times the market cap weighting, which would be about 4% of global equity markets. But there's increasing evidence that actually having a home country bias isn't such a bad thing for a couple of reasons. One of them is that if you want to beat domestic inflation, the place to do that is with domestic stocks. So that's one interesting take on it. And certainly the back tests, some of the back tests that people have done, show that having a fairly big overweight for domestic stocks, bigger in the US than elsewhere, it has to be said, isn't a bad idea. It usually does well. It doesn't make a huge difference, but it does boost return a little bit on average over a 30-year investment horizon or a 30-year drawdown period. So yeah, anyway, have a listen to that. It's a bit like this in the sense that it's kind of informal. We laugh a lot. Michael's super bright, so he kind of structures it so I don't rabbit on like I am now. And people find it quite entertaining. Do have a listen. And how are we doing? We've got 3 minutes. One more question. Jeremy Alphabet Vunbo Ng says, speak up, mate. You're not loud enough. Well, hopefully we've addressed that. Okay. Oil will explode, says Timmy T. Back to all-time high when the S&P goes down. There we go. I'm not sure that's going to happen, but certainly people are saying that energy prices will rise towards the end of the year because it's more likely we'll have supply issues at that point. I'm sure that countries which produce oil want to fabricate a crisis at the times when LNG, liquefied natural gas demand, but also liquefied natural gas demand is highest. And of course now the supply of liquefied natural gas, many countries have moved away from Russia, which was a big supplier. So a smaller group of suppliers, and if there was some kind of supply constraint, that could cause a surge in the price of LNG. But oil, maybe, yeah. It is an unpredictable thing, oil. Someone's saying the possible Labour victory might tank bank stocks in the short term. I'm not convinced that's true, because remember that banks are a really important part of the economy, and if Labour wants to engineer growth, they're not going to want to scupper the banking system, because who makes money? The primary source of new money is not the central bank, it's retail banks and commercial banks. when they make a loan, effectively, they create money out of nowhere. And a lot of the money that's created is created by commercial banks. So what you don't want is to scupper growth by, hamstringing all of your banking system. So Labour is not going to want to do that if growth is what they want. And I think Rachel Reeves is pretty economically literate. She's an economist, a good one. So I think it's unlikely she's going to do that. But yeah, I don't think it's going to tank bank stocks, actually. In fact, if they do manage to engineer some growth, or at least not scupper growth, then I'd expect the banking sector in the UK to do okay. But it is such a tiny sector. You compare it to US tech stocks, it's just absolutely tiny. Code Rider says, I managed to listen to all Many Happy Returns episode. Wow. I don't think I've listened to all of them, but only while I was talking, clearly. Sometimes not even then. Last one, yeah. Do you believe that investing in US and UK ETFs gives you enough cover in emerging markets? No, it doesn't give you any. So unless you mean ones which are sold in those countries. So you can buy EM ETFs. You can buy single country ETFs. There aren't many of them. There are now ex-China EM ETFs. So you can exclude China. So you'll buy a lot of India, which is expensive, and a lot of other EM countries, which are much smaller and potentially have good upside if global growth is good. So those are options. You can always twist it. You can always have a tilt to EM by buying a separate fund. But yeah, I think it's possible to get the exposure. It's simply a question of whether you should get the exposure. And usually if someone's going to be investing for a long period of time, I think having some EM exposure is a good thing. For someone of my age, having that risk is not such a good thing, I don't think. But, if you're in your 30s, 40s, having some EM exposure is probably sensible because valuations are low, growth globally is kind of okay, so you would expect some kind of EM outperformance at some point, assuming the good times carry on rolling. But look, anyway, we'll draw a line under it there. Thank you for joining us. Don't forget, you can do a one-to-one session with me, and that's called a power hour. And go to our website, PensionCraft.com/coaching, to find out more about what we offer and also how much it costs, and you can book it there. Join our community. It only costs £16 a month, and you get access to Slack, explainers, trackers, so you can look at the yield curves, also fair value models, and of course our chat, so you can ask questions whenever you like. And of course, you help support us, which makes a big difference to our lives, certainly. Pays for Teddy's treats. And please do listen to our podcast, free of charge. You'll find it on Spotify, Apple Podcasts. And that's Many Happy Returns. And as always, thank you for joining us and good luck with your portfolios.